The US has a $36 trillion ticking debt time bomb. The US government is now spending nearly $1 trillion. This is the biggest national debt globally. The US has a $36 trillion ticking debt time bomb, and it's ticking louder than ever. The IMF has also sent a warning, and today we'll look at analyzing what is the US debt crisis and what does it mean for us as investors. We'll be looking at three primary questions. What exactly is the debt time bomb? Why is it hitting a critical point right now? And why is the whole world seemingly paying attention to this phenomenon? When you look at the number 36 trillion, I mean, it's just staggering, isn't it? This is the biggest national debt globally, and it's also over 120% of America's entire economic output, its GDP. And it's a level that apparently hasn't been seen in the US since the Second World War. And that should put it into perspective. This really sets the stage for the core problems that we are going to get into today. So let's start. There are four brutal truths about the massive debt problem that the US has. The first is that the US has a spending problem. The US government has consistently run a budget deficit every single year, regardless of how the economy is doing, be it booming or if it's in a recession. So the US has spent significantly more cash than it brings in year on year. And if you think about it, as someone who's constantly wanting more expensive things, potentially buying it on credit or on EMI, but they don't have enough of their capital, enough of the revenue or the paycheck to be able to cover that monthly bill. That's essentially what the problem is right now. And you can see this on this graph that's there on the screen. So where does the US spend its money? The US spends on things like defense, social security, Medicare, and mandatory interest payments that are accumulating because of the debt that they have taken on. About 70% of the federal budget is accumulated by these 3-4 things that we spoke about. Defense spending on its own is about $800 billion, which is more than the next 10 countries after the US. Then on top of that, you can add in things like the increasing cost from an aging population, huge recent spending on things like COVID stimulus, military aid, infrastructure projects. You can just see how this spending side starts to balloon and become bigger and bigger. So now the second problem, the second truth that we'll look at for the US debt problem is that they don't generate enough tax. There's not enough revenue in the system. So you've got this persistent, really high spending that immediately brings up the next question, which is what about the money that's coming in, the revenue side? Well, there is a trend over decades where tax cuts have disproportionately been benefiting the wealthiest Americans. As you can see in the graph, about 20% of the richest Americans receive nearly 65% of all federal tax cuts. These cuts have made wealthier people richer, but the government revenue didn't really keep up pace with the spending. So ultimately there's a gap that is becoming wider and wider. So as the spending goes up, revenue doesn't keep up pace and the government has to borrow more to make up this difference. And this naturally leads us to the third problem. This is the interest problem. And this is where the numbers get really alarming. The US government is now spending nearly $1 trillion simply on making interest payments on their borrowed amount. And that's more than the entire GDP of 174 countries. That's incredible. That creates a really concerning cycle, almost like a feedback loop. High spending creates a deficit. The deficit is basically where the government has to borrow more money. Borrowing incurs interest costs. These interest costs add to the deficit, which means they need to borrow more, leading to even more higher interest costs. And at the current rate that the US economy is at, the combined effect will ultimately cause interest payments to consume nearly 6.5% of the US economy per year. And well, you see the pattern. It just keeps feeding itself. This is essentially a debt spiral, and it's apparently been building for a while. The US has repeatedly hit its debt ceiling. This is the legal limit that the Congress has set for the borrowing. And what do when they hit it? They just legally raise it again and again, and they've done it 70 times since the 1960s. 70 times. Now here's an interesting chart. From 2020 to 2024, the US has added $12 trillion to its national debt, which has been as a result of the massive spending spree that they took on post-COVID. It took the government nearly 220 years to reach the first $12 trillion in debt. So is it really a limit, or is it just a guideline that just keeps revising itself? So if they've managed this before by simply raising the limit and moved on, why is it such a big deal now? Well, similar to 2011, what we've just seen is that the credit rating agencies such as Moody's, S&P, Fitch, they've gone and downgraded the US government bonds. But why have they done this? Well, there is heightened fear among investors that there is a potential economic heart attack that as the demand for US Treasury bonds is falling. Why is that important? Well, that's how the US government borrows money. Now, when the credit rating drops, investors get more worried. They demand even higher returns for the extra risk that they're taking on, which pushes the interest rates up even more. And this is where the debt spiral comes in. It's the fear. If bond demand is low, the US has to offer higher and higher interest rates to get more people to buy that debt. So who is it that's buying less? Well, typically we have large countries like China and Japan who have now in the recent times cut back their holdings. This has been seen as one of the responses to the uncertainty that Trump has caused by undertaking his trade war with pretty much the entire world. You can start seeing why demand for US debt in countries like Japan and China could continue to fall further and further as the trade war worsens. Now, China's holdings have gone from about $1.3 trillion to about $759 billion since 2012. That's a big drop. And Japan is also down from about $1.8 trillion to about $1 trillion. So less demand overall, and if this demand for bonds continues to fall for US debt, that means the US has to offer higher interest rates to attract more buyers to purchase these bonds. The government has to make the bonds more attractive, which means that the higher interest rates that they take on to the new debt, which of course means that the borrowing becomes more expensive for the government, which ultimately keeps on adding to the interest problem that we spoke about earlier. So there's a new tax cut bill that the Trump administration has proposed. The bill would make previous tax cuts permanent, significantly boost military spending, while also cutting healthcare, Medicaid, welfare programs, etc. This specific bill is estimated to cost up to $3.3 trillion to $5.2 trillion in terms of national debt that could be added over the next 10 years. And that's trillion with a T. Potentially pushing the annual budget deficit well over $3 trillion and the annual interest payments closer to about $1.8 trillion a year. That's nearly double where they are right now. And how big is that? Just to give you the scale. Now that's roughly the same as the entire GDP of, let's say, India and Germany combined. And that's just being added to the debt, which makes the annual deficits explode and ultimately increases the interest payments that we spoke about earlier. So as you can think about this new legislative action that the government is taking is being seen as adding fuel on top of the fire. It worsens the underlying issues, pushes the government faster towards a debt spiral scenario that we spoke about earlier, where the ballooning interest costs forces the government to take on even more borrowings, which ultimately will push up interest rates higher and higher. And that's what we can see the 30-year US Treasury yield sort of increasing. And all of this that we've spoken about, the existing deficits, the rising rates, falling bond demand, potential policy changes that are happening, is why the credit rating agencies have now started taking action on the US government debt, which is considered to be the safest asset class. And there are serious fears of a major economic event if these issues persist. So all of this is very interesting from a global and a macroeconomic perspective, but why does this matter to you? Like, how does a US debt crisis potentially impact your life, your finances here in India? Well, the first thing is that there could be a Indian stock market bloodbath. We have typically seen that if the US goes into a major crisis or a recession, that leads to Wall Street panicking. And when Wall Street panics, that tends to have some sort of a correlated effect on other global markets because there is more panic, there's more fear. The foreign institutional investors, the FIIs, tend to pull money out of the markets that they see riskier, such as India or any other emerging markets. And they tend to move these into assets that are typically considered safer, such as US Treasury bonds, ironically. And if the interest rates are higher, then that gives them a better yield and a better attractive proposition for them to move into US Treasury bonds. In 2011, when the US credit was downgraded, Indian markets lost nearly 10% over 3 months. And it was driven by this global panic that happened. There was a flight to safety. Money was flowing back into the US dollar. And the dollar can actually get stronger in these sort of crisis scenarios, even if the crisis ultimately originated or happened in the US. So there could be potential capital shifts that we could be looking at over the next few months, ultimately being driven by the US problem. And this could have an impact on the Indian market conditions, even though we have seen some sort of lack of correlation with the US markets. Now, the second point is that the Indian rupee could fall into more volatility, more chaos. Ultimately, 70% of global trade is happening in dollar. it is the dominant currency. If the US economy has major problems, the dollar could swing up and down, and these swings could be quite volatile. And this is where the rupee or any other currencies could also potentially be dragged, even if the Indian economy or the fundamentals are strong. Initially, there might be this bit of volatility, but as the crisis deepens, investors may sell Indian assets because they want to move to safer assets classes like we discussed earlier. Typically, these are the FIIs that we're speaking about, and they will sell rupees to buy dollars, which ultimately pressures the rupee and makes it more weaker against the dollar. India holds roughly around $230 billion worth of foreign exchange reserves in US government bonds. If the crisis worsens, the bonds could lose value, and that could also hamper RBI's ability to step in and defend the rupee from falling too fast. And again, looking back at what happened in 2011, we see that the rupee did stumble, and it also contributed to inflation. And that's our third point here, that the cost of borrowing, inflation will rise. And this increase in the cost of borrowing is going to largely be driven by what's going to happen in the US bond yield curve. Since US rates ultimately act as a global benchmark, higher yields in the US mean that there is an increase in borrowing cost worldwide, which makes mortgages, business loans, home loans, any type of credit ultimately more and more expensive. And what this means is that it could hamper or limit the asset ownership, especially in real estate, for the middle class, which is where most of the people typically look at in terms of financial planning, affordable debt, etc. And ultimately, another trend that we saw earlier was inflation. It'll be steady and stubborn price hikes in terms of essential goods and services like healthcare. And typically in India, if you look at it, medical inflation has been around 14% annually, while the middle class salary growth or the wage growth has sort of stayed stagnant about 0.04%, which ultimately means that there is an erosion of purchasing power for the Indian middle class. So final thoughts on this. In a world where major economies are wrestling and are facing significant debt levels compared to what we have seen historically, what that means is that there could be more volatility, there is going to be more uncertainty and potentially bigger societal shifts, especially as Trump continues on the path of trade wars and tariff wars with various countries. Ultimately, as an investor, you need to think about how does this change or have an impact on you for your financial future. What is your planning? What is your strategy? Do you move to safer assets classes, or do you look at it from a longer term perspective to ride out the volatility that might be coming up? It's definitely something that you should sort of think about and give some serious thought to as you navigate the years ahead. If you liked our video today, do let us know in the comments. Do share, like, and subscribe. If there's anything that you want us to cover in the next week, do let us know in the comments as well. Thank you so much. Happy investing.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.